Content creation often begins as a hobby, a bedroom project that slowly builds an audience. But there is a specific moment when that hobby transitions into a business, a point of sudden, monetized scale. Once you deposit that first sponsorship check into a personal bank account, the law classifies you as a sole proprietorship. In this default state, the legal boundary between you and your business does not exist. Operating under your personal name means that your savings, your car, and your home are legally tied to every piece of content you post. Imagine a rising creator who lands a $20,000 deal with a skincare brand. She signs the contract using her personal name and invoices them via her personal email. Later, she receives a cease and desist letter alleging she breached an exclusivity clause by featuring a competing product in the background of a story. The brand's legal team targets both her channel's revenue and her personal bank account. Because she lacks a formal structure, her private wealth is now the primary source of recovery for the brand's damages. Early monetization without a legal barrier is a risk that leaves your personal life exposed. Without protection, a simple contract dispute can become a total financial crisis. The legal architecture used to mitigate this risk is the single-member LLC.
This video contains affiliate links. Before we dive into the exact strategies for landing 5-figure brand deals and locking down your content rights, let's talk about the foundation. You absolutely cannot protect your assets as an influencer without a properly structured business entity. Most creators try to run their channels as a sole proprietor, signing massive sponsorship contracts in their personal name. And that is exactly why they leave their personal savings completely exposed to copyright lawsuits or contract disputes. Your brand needs to be a legitimate, separate legal entity to shield your personal life and ensure you actually own your intellectual property. That's where Busy comes in. Busy handles your entire LLC formation for just $0 plus state fees. They take care of the heavy lifting, your articles of organization, a registered agent service to keep your home address off public records, the EIN you absolutely need to get paid by sponsors, and compliance alerts everything required to establish that legal wall between you and your content. This is non-negotiable if you want to scale your platform safely and protect your wealth. I've put a special link in the description below. Use my link to get your Creator LLC set up through Busy today, and you'll also unlock some exclusive perks and discounts. Get that handled first.
A single-member limited liability company is a formal structure combining the simplicity of a sole proprietorship with the legal protections of major corporations. Its primary function is to draw a line in the sand between your personal identity and your business operations. While you can form one at any time, the threshold where this upgrade becomes necessary is usually around $5,000 in monthly revenue. At this level of income, your exposure to contract disputes and FTC compliance risks increases. The Federal Trade Commission, or FTC, is the agency that regulates consumer protection and ensures influencers clearly disclose paid endorsements. Protecting your assets requires a specific trade-off. You have to move past the zero-cost convenience of a sole proprietorship and invest in the administrative framework of a formal entity. Once you cross that $5,000 mark, the LLC is no longer just an administrative burden. It is the firewall that protects your future earnings. Establishing this firewall requires a specific set of mechanical steps. Step 1 is filing your articles of organization. These are the formal legal documents submitted to your state government to officially register the company, which includes paying an initial filing fee. Step 2 is designating a registered agent. A registered agent is a person or third-party service located in your state that is legally authorized to receive official government documents and lawsuit notices on behalf of your business. Step 3 is drafting an operating agreement. This internal document outlines exactly how your company is run, and even for a single owner, it serves as evidence that your business is a separate entity from yourself. Step 4 involves obtaining an EIN from the IRS. An EIN, or Employer Identification Number, is a unique 9-digit code that acts like a social security number for your business, allowing you to hire help and pay taxes. The sequence concludes with the final step, using that EIN to open a dedicated business bank account. Maintaining this structure involves ongoing costs, including annual report fees and strict state compliance deadlines. These maintenance fees depend heavily on your location. High-fee states like California charge a minimum of $800 a year, while states like Wyoming offer lower costs and additional privacy protections for owners. Successfully navigating these 5 steps is the only way to activate your legal immunity. Without the paperwork, the protection doesn't exist. If you follow those steps and manage the business correctly, you create the corporate veil. The corporate veil is a legal barrier that prevents creditors and litigants from reaching your personal assets to satisfy business debts. But this veil is conditional. It stays intact only if you maintain a total separation between your personal wallet and your business treasury. The primary way creators destroy their protection is through commingling. Commingling happens when you use the business account for a personal vacation or use your personal card to buy gear for the channel. In a lawsuit, if a judge sees that you haven't respected the line between your accounts, they can pierce the corporate veil. This instantly voids your protection and puts your personal savings back in the line of fire. Protection requires more than just filing the paperwork. It requires a permanent change in how you handle every dollar your channel earns. Beyond internal protection, an LLC changes the physics of your brand deals. You stop signing contracts as an individual. Instead, you sign every agreement as a representative of your company, such as Creator Name LLC. This simple change ensures that if you are sued over an exclusivity breach or an FTC disclosure failure, the brand can only pursue the assets owned by the business, not your personal home or investments. It also provides a stronger position for managing content rights. High-value brand deals often include aggressive morality clauses and demands for the perpetual use of your name, image, and voice. When you operate as an LLC, your company, rather than you personally, retains ownership of your copyrights and trademarks. This allows your business to license specific rights to the brand for a set timeframe, rather than you surrendering ownership of your likeness forever. Without this structure, creators often sign away their likeness in perpetuity, meaning a brand can use their face to sell products for decades without paying another cent. Transitioning to a formal entity also shifts how brands perceive you. They expect the professionalism of structured invoicing and official tax forms, which often leads to higher value partnerships. Timing is critical here. If you sign a major deal before your LLC is formed, that specific contract is not protected. The shield only covers the deals signed after the business is registered. An LLC moves the creator from an exposed individual into a legally shielded professional negotiator. There is a secondary benefit to this structure: pass-through tax efficiency. Pass-through taxation means the LLC itself does not pay federal taxes. Instead, the profits pass directly through to your personal tax return. This avoids the double taxation faced by major corporations while allowing you to legally deduct your business expenses. You can deduct legitimate costs like high-end camera equipment, your monthly software subscriptions, and even a dedicated home studio. The main tax limitation is that you are still subject to standard self-employment taxes on all of the channel's profits. As your profits grow, you can eventually elect S-Corp status. An S-Corp is a tax classification that can reduce your self-employment tax burden by allowing you to take a portion of your income as a distribution rather than a salary. The decision comes down to weighing the protection and tax benefits against the upfront costs and the ongoing administrative burden. If you are a casual hobbyist doing free product exchanges, an LLC is likely an unnecessary expense. The costs will outweigh the immediate risks. But for creators earning consistent revenue and signing professional sponsorships, those administrative fees are the price of securing your personal financial future.